Have you ever noticed how some people seem to build wealth effortlessly while everyone else is stuck spinning their wheels? They open an investment account, buy a few index funds, and somehow their net worth keeps climbing year after year. Meanwhile, other people are constantly chasing the next hot stock, the latest crypto trend, or whatever financial guru is promising quick riches this month. And here's the frustrating part. A lot of those people are investing completely out of order. They're putting money into the stock market while carrying high interest credit card debt. They're buying individual stocks before building an emergency fund. Some are even investing in speculative assets, while living one unexpected expense away from financial disaster. It's like trying to build a second floor on a house that doesn't even have a foundation. My name is Alex, and I spend way too much time thinking about money, investing, and why so many people make wealth building harder than it needs to be. If you want to make smarter financial decisions and build wealth the right way, hit that subscribe button and let's get into it. Because today, I'm going to show you the exact order that I believe most people should invest their money. Not the exciting order, the effective order. And trust me, getting this sequence right can save you thousands of dollars and potentially shave years off your journey to financial freedom. Let's start with a statistic that should make everyone uncomfortable. Millions of people have investments, but no emergency fund. Think about that for a second. They own stocks. They might have a retirement account. Some even own cryptocurrency. But if their car breaks down tomorrow or they get hit with an unexpected medical bill, they're reaching for a credit card. That makes absolutely no sense. Before you invest a single dollar, you need a financial cushion. An emergency fund isn't exciting. Nobody brags about it at parties. Nobody posts screenshots of their emergency fund balance on social media, but it might be the most important financial tool you'll ever have. Because investing only works when you're able to leave your money alone. If you're forced to sell investments every time life throws you a surprise expense, you're constantly interrupting the compounding process. So the first goal is simple: build an emergency fund. For most people, I recommend starting with your first $1,000 as quickly as possible. That covers many small emergencies and immediately reduces financial stress. After that, work toward 1 month of expenses, then 3 months. And eventually, if your job is less stable or your income fluctuates, 6 months may make sense. This isn't just about money. It's about peace of mind. When you know you can handle unexpected expenses, you make better decisions everywhere else in your financial life. Now, once you've established that safety net, it's time to deal with the biggest wealth killer most people ignore: high interest debt. I cannot tell you how many times I've seen someone proudly tell me they're earning 8% in the stock market while paying 24% interest on a credit card. That's not investing. That's financial self-sabotage. Imagine carrying a bucket of water up a hill while somebody punches holes in the bottom. That's what investing while carrying expensive debt looks like. Every dollar you use to eliminate high interest debt provides a guaranteed return equal to the interest rate you're avoiding. And guaranteed returns are incredibly rare. If a credit card is charging 22% interest, paying it off is essentially like earning a guaranteed 22% return on your money. You won't find many investments that can compete with that. So after building a starter emergency fund, focus aggressively on eliminating high interest debt. Credit cards, personal loans, anything charging double-digit interest rates. Get rid of it. But there is one major exception, and this is where many people get confused. If your employer offers a retirement match, take it immediately. Let's say your company matches 50 cents for every dollar you contribute up to a certain percentage of your salary. That's free money. If you contribute $100 and your employer adds another $50, you've earned a 50% return instantly. You didn't wait a year. You didn't take any market risk. The money simply appeared. That's why employer matching is often worth prioritizing even before eliminating every dollar of debt. The key is contributing just enough to get the full match, not more, just enough to capture every free dollar available. Once you've done that, go back and finish attacking any remaining high interest debt. Now, let's talk about something most people completely overlook: tax advantages. Because building wealth isn't just about making money, it's about keeping more of it. And that's where retirement accounts become incredibly powerful. Once your emergency fund is solid, your expensive debt is gone, and you're getting your full employer match, the next priority should be maximizing tax-advantaged accounts. For many people, that means an IRA. Why? Because IRAs typically give you more investment choices and often lower fees than employer retirement plans. Small fees may not seem like a big deal, but over 20 or 30 years, they can quietly eat away tens of thousands of dollars. That's money that should have stayed in your pocket. Then there's one of the most underrated wealth building tools available today, the Health Savings Account, or HSA. Most people think of it as a healthcare account, but financially, it's much more powerful than that. An HSA can provide a tax deduction when you contribute, tax-free growth while invested, and tax-free withdrawals for qualified medical expenses. 3 separate tax advantages in one account. That's incredibly rare. If you qualify for an HSA, it deserves serious attention, especially because healthcare is one of the largest expenses many people face later in life. Once you've maximized those options, then it's time to increase contributions to your workplace retirement plan. At this point, you're building a powerful, tax-efficient wealth machine. You're protecting your money from unnecessary taxes while allowing compound growth to do its thing year after year. And here's something interesting. Most people never reach this stage, not because it's impossible, because they get distracted. They jump from one financial trend to another. They chase excitement instead of following a system. But if you've worked through these steps, you're already ahead of the majority of people. Now finally, we arrive at the place most beginners want to start. Taxable investment accounts. This is where things get flexible. You can invest as much as you want. You can buy index funds, ETFs, individual stocks, or other investments. There are no contribution limits, no early withdrawal penalties, complete freedom, and that's exactly why people love them. But here's the catch: taxes. Every dividend, every capital gain, every profitable sale, the government wants a piece of it. That's why taxable investing should usually come after you've exhausted your tax-advantaged opportunities. Otherwise, you're voluntarily giving away money you could have kept. Now, does that mean taxable accounts are bad? Not at all. They're incredibly useful. Maybe you're saving for a future house. Maybe you want to retire early. Maybe you simply want access to money before retirement age. Taxable accounts provide flexibility that retirement accounts can't. The important thing is understanding where they belong in the sequence. Last, not first. And this brings us to the biggest mistake investors make. They focus on what to invest in before figuring out where their money should go. They're debating index funds versus individual stocks while carrying debt. They're researching crypto projects while living paycheck to paycheck. They're worried about beating the market when they haven't even built a financial foundation. That's backwards. The truth is, wealth building isn't complicated. It just requires discipline. Emergency fund first. Eliminate high-interest debt. Capture your employer match. Maximize tax-advantaged accounts. Then invest through taxable accounts. Simple. Not flashy, not exciting, but incredibly effective. Because successful investing isn't about finding the next big thing. It's about consistently doing the right things in the right order. And if you can master that, you're already ahead of most people. Your future self won't care whether you picked the hottest stock of the year. They'll care that you built a system that allowed your wealth to grow for decades. And that's how real financial freedom is created.